Bloomberg Tech is live from the heart of Silicon Valley with Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, it's an upsized share sale for Intel, raising $20 billion, a third more than it was targeting when it announced the deal yesterday. Plus, sources tell Bloomberg Apple's glass-centric iPhone overhaul is still on track for 2027 after an analyst's report said it had been cancelled. And drone startup Neros raises $250 million in a funding round that triples its valuation. We'll talk to Neros CEO Soren Monroe-Anderson and one of its lead investors, Sequoia partner Shaun Maguire, later this hour. Intel gets big demand for its share sale. We're flat in Tuesday's session on a two-day basis. It's a decline of 4%. Remember, this is a stock that's up 164% year to date, also seeing its value almost triple. $20 billion sold in the end. They had initially marketed $15 billion. There was probably about 5 times that in terms of demand, Bloomberg reporting, citing sources. Let's get more. Bloomberg's Ian King, who leads our semiconductor coverage, is with us. Let's go back over the basics. Intel said we will sell $15 billion worth of stock. In the end, they sold 20. Where did they price it? What did demand look like?
Yeah, I mean, demand is obviously strong. Our reporting says that as many as a third of the people who tried to buy the stock weren't able to do so. So obviously this is a strong endorsement of the future prospects of this company, that they're able to attract new shareholders. We're seeing in the market, obviously some of the existing shareholders don't like being diluted, but in general this is a pretty strong signal that Intel is going to be joining the AI race and that people believe that.
Why do they need to sell stock? What do they need the $20 billion for?
Yeah, I mean, the number one priority of this management team has been to sort out this balance sheet, right? They've got about $50 billion in debt. Up until this offering, they had about $30 billion in cash. Obviously, that situation is improving. This takes them very close to being sort of net cash positive, which is a real turnaround from where this company was just a couple of years ago, and obviously gives them a much more solid footing to do new products, to build new factories.
We're recapping what we talked about 24 hours ago, basically, but that's because the deal's now been done. Yeah. We said in the Bloomberg story this was the first time Intel did a public share sale since 1971 when it listed. Different company now. Part of this is they are a bit more adventurous with CapEx, and you explained that yesterday. They have to buy chip-making machines.
Right. I mean, $20 billion is a lot of money, maybe not for somebody who works on TV, but for us print reporters, it's a huge amount of money. But in the grand scheme of things, if you are trying to do leading-edge semiconductor manufacturing, $20 billion doesn't really even get you a full factory from the ground up, right? So huge numbers, and that kind of factory goes away within 5 years. It's not as useful as it used to be. So
now, very quick, this is not a GPU story. This is a CPU story.
That's right. I mean, Intel has joined the party by accident in a way, because the way that the AI factories are working, the way that the software is being run is kind of shifted back towards general computing, and that's where Intel's strength is. There's a shortage and a lot of demand for what they make.
$20 billion is a lot of money and a big number for Bloomberg's Ian King. Let's take a look at today's official big number, $500 billion. That's how much capital NVIDIA is looking to mobilize from US investment giants Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR. The idea, Wall Street raises debt backed by NVIDIA compute, then leases that compute to customers, according to a Bloomberg source. It effectively turns GPUs into a financeable infrastructure asset. Our next guest says that the AI infrastructure build-out is among the key factors driving markets, and our global economy is being reshaped for the next phase of the Industrial Revolution. BMO Wealth Management Chief Market Strategist Carol Schleif joins us now. So the idea in this story is compute as collateral. How do markets digest that?
I think markets have done a really great job of digesting a lot of this and being super discerning this year. You've seen it in the bond market. You've seen it in the stock market. You've seen it in reaction to earnings and the parsing of that. So I think having asset-based finance is, those 6 key players think the asset-based finance is there. And I would suspect that the demand will be there, not unlike the prior story where you were talking about the demand for Intel shares.
Right. Carol, the pitch from Jensen Huang and NVIDIA is that compute becomes an investable infrastructure asset class of its own. Would you regard it as an asset class?
Possibly. I mean, it would definitely take some looking at. The key thing is, too, it's hard for investors to play infrastructure because technology is such a large percentage now of the S&P, and infrastructure and manufacturing has shrunk to so small. And we are in the very early stages of repositioning that, especially as we reshore. It's primarily about AI, but it's also about all of the stuff that supports AI and all of the things we can do with AI. And we need hard assets to be able to do that.
There are some circular financing concerns. NVIDIA would say there's a degree of separation here because this is third-party capital, right? Those 6 asset managers, investment managers go out and find the investors. NVIDIA doesn't finance the project. How does that sit with you in the structure of this market right now?
You know, the interesting thing is there's circular financing in a lot of ways. You look at even the earnings of some of the hyperscalers had one-time events in there from write-ups of OpenAI and their venture investments. So you've got circular financing in the equity market, you've got circular financing in the debt market. And the key is you've got a whole bunch of the economy really leaning on those. But I think it's important, too, to consider it's not just the data center build-out. That's the infrastructure, a piece of the infrastructure we need. But A, we haven't invested in infrastructure here in a big way in decades, so we need to have a lot of catch-up to do. But B, it's also about the usage and what we can do with it and the levering and moving into a whole new scenario, because there's the kinds of questions we couldn't even ask before that we can ask now because we have technology to help us figure out the answer.
I want to go back to our opening statement about rewiring the global economy. Data centers are a big part. Data centers are being built in the United States. There are other things happening in the United States, the re-onshoring of all kinds of industries, semiconductor capacity. How do those other lanes factor into your assessment of the economy and what markets are really focused on right now?
I think the interesting thing is, too, is like, let's not forget automated manufacturing. It's been going for a long time, too. And as we pull stuff back in, as we build infrastructure, and we put sensors in bridges, and we do lots of different things, there's all sorts of aspects that they may run on an infrastructure of AI or be accelerated by AI, but they're also about the nuts and bolts of putting capital back on the S&P 500's balance sheet. Because if you look at it where it was in the 1990s, that's substantially more capital intensive businesses. Then we went to very much asset light businesses, and now we're swinging that pendulum back. And those industries are only a small upper single digit to low double digit percentage of the S&P, and there's room to grow.
We should probably talk about the stock market. There's been rotation. Semiconductor stocks, the Mag 7, does that continue to your mind? And if so, why?
I think a piece of it does. And I'm not quite sure if it's the combination of investors who didn't get a chance to get in and then had a chance. I mean, when you look at the chip stocks, even in the last quarter, I mean, they're up substantially year to date, up in the quarter, but they had a nearly 50% pullback in the quarter. So there's the opportunity to get reinvested. I also think exacerbating things definitely at the fringes are these hyper levered ETFs, especially the single stock ones that are putting things around, and the very crowded trade, and the fact that you've only got a handful of names that everybody can play.
We're going to go very big on the big take around those highly levered ETFs later. Just really quick, the other thing that's true is bond yields go up. Is there a connect between that and technology stocks?
The interesting thing with the technology stock piece is that theoretically, textbook would tell you that higher interest rates should lead to a lower discount rate for tech stocks and lower valuations. But I think a piece of what's pushing those rates up, especially at the long end, is the growth that we're seeing and the bottlenecks that you're seeing in technology. And I think the hope is longer term, you see some disinflationary impact.
I feel like Bart Simpson on the chalkboard. Higher rates discount present cash flow, value of future cash flows, etc. Carol Schleifer, BMO Wealth Management, back on the show. Thank you very much indeed. Now, coming up, sources tell Bloomberg Apple's glass-centric design is still on track for 2027, despite an analyst report saying it had been scrapped. We got the details next. This is Bloomberg Tech.
in 2027, that's the 20th anniversary of the iPhone. And that's why our understanding is that Apple actually has this new design, which is all glass. I think that over time, this form factor may actually be transported to the Pro and Pro Max, maybe in FY28 and FY29 as well. So this is how Apple intended to move up the product roadmap and move up the ASP, which I think is very important right now, given soaring memory costs.
That was Jefferies analyst Edison Lee, who downgraded his call on Apple yesterday after his supply chain checks led him to conclude the iPhone maker had cancelled a 20th anniversary all-glass handset. Overnight, Bloomberg reported that iPhone is still on track. Let's try and understand this. Some analysis with Anurag Rana of Bloomberg Intelligence. It's almost in isolation, the idea that there will be a 20th anniversary largely glass handset. The bigger point that Jefferies was making is they want to see Apple find a mechanism to raise ASPs and maintain higher ASPs for longer. Let's start there. Why does that even matter?
See, the reason it matters right now is because of higher memory prices, you will have an impact on unit shipments. Now, Apple's really gained market share over the last 2 quarters. And in fact, we think it's going to be this quarter as well, because it's only one of the only ones in the premium segment that has not raised iPhone prices. And that's going to most likely happen in the fall. So, eventually when you raise prices for consumer devices, the shipments don't go down. So ASP increase is the single most important thing for them to continue to show iPhone segment growth rate for the next couple of years.
In Mark Gurman's reporting, we don't have a price for the proposed 20th anniversary glass-centric iPhone. But I guess the logic is that would be a premium model. It's one mechanism, along with the folding phone, to have a mix of handsets where you can command higher ASPs.
Yeah, absolutely. In fact, the foldable, if it comes out to what I think Mark has said, somewhere around $2,500 or somewhere in that range, I mean, yes. That's a massive lift compared to whatever the basic price of $1,200 or $1,300 for a Pro Max or somewhere in that. So, I mean, you can even imagine for that audience that can buy a Pro Max, you're going and getting a similar device with a much higher ASP. So that's a big lift to that. The question really is, how many of those are there in your ecosystem? Because think about it, Apple sells somewhere in the range of 220 to 240 million phones a year. I mean, how many of those could be in that category? So I think that's a more important piece at this point. But memory price is far more important for Apple than anything else.
What Mark reported last night is that Apple still plans to launch iPhone Pro models next year that have the glassy look, glass used on the front and back, curving into the size of the devices that have a metal band. An Apple representative declined to comment. Real quick, what did Apple get wrong in that earnings print last quarter? Was it supply chain mismanagement, misreading demand?
I think it could be just a matter of that the stock has gone through a massive run. I mean, if you look at the multiple before it started to go down, it was in the low 30s where all the hyperscalers were, trading in the low 20s. So I think it's a big mismatch in terms of valuation than anything else. I think everything else they said was pretty much in line with what people were expecting, and a big iPhone number, which is not easy to replicate, frankly, given the history of the phone being saturated around the world.
Anurag Rana of Bloomberg Intelligence, thank you very much. This is a top story. A New York City proposal backed by Mayor Zoran Mamdani is risking Amazon's cheap delivery model. The Delivery Protection Act aims to close a loophole that's allowed Amazon to distance itself from worker injuries and grueling conditions. But the e-commerce giant argues this could make delivery slower and more expensive. Bloomberg's Spencer Soper has the story. Loads of people reading this morning. Just explain what is at issue here.
Well, so Amazon has done this nationally for the past several years, really built up its last mile delivery network. And it's done it not by hiring delivery people directly. It's kind of stood up this network of small businesses that directly employ these delivery people, usually drivers, but can also be electric cargo bicyclists and even people in New York pushing carts on the sidewalk. So what the Delivery Act is looking to do is saying, hey, Amazon, we want you to employ any of those people directly. And so it's not just specific to Amazon. It would affect any company with delivery hubs in New York City, making deliveries to people in New York City, and it would require them to directly employ those delivery people. It's very convoluted subject, but it gets at this subcontractor model, which is a way that a lot of big companies can kind of unload the costs of their operations by relying on smaller businesses who offer them better costs on labor.
The proposed legislation aims to close that loophole. Amazon is acting in response. They want to oppose the measure, but what literally does that response look like?
Well, they've thrown about $5 million at this. By comparison, FedEx would also be affected by this. They've donated like 1/100th of that amount. So Amazon's really coming at this in a big way, because if this passes in New York, other cities could replicate it. So Amazon's not just thinking about, oh no, this could hurt us in New York City. They're worried, like, man, if other big cities see this as a labor-friendly move that is good for their constituents, this really threatens our model on a national scale. So that's why Amazon's coming out so hot and heavy, try to nip this thing before it even gets out of the gate.
Bloomberg's Spencer Soper published the story this morning, and a lot of people engaging with it on the terminal and on .com as well. Thank you very much. Coming up, Rum Group is fresh off a record quarter with revenue jumping 61%. We're going to talk to CEO Chris Pavlovski about what's driving the growth. And spoiler, it's an AI story. This is Bloomberg Tech. Rum Group coming off a record quarter with second quarter revenue jumping 61% from a year ago to more than $40 million. Now forecasting as much as $93 million this quarter as it pushes deeper into AI infrastructure. Rum Group CEO and founder Chris Pavlovski back with us. June 17th, you closed the acquisition of Northern Data, and in this quarter gone, that shows up as a $10.1 million contribution. So it's early. But let's start there. You know, how had that gone, and what's the direction of travel? And maybe just explain the pivot that you made.
No, absolutely. Thanks for having me back on. So in Q1, we did $25.5 million. In Q2, which we just reported, we did $40.4 million, which is a record for the company. We closed Northern Data in mid-June. We rebranded the company to Rum Group. So now we have two divisions. We have the video platform, which is Rumble. And on the other side, we have Quake AI, which is the AI compute as a service business. And that showed up in the quarter. And we posted a record in the history of the entire company since the inception of going public. And we, for the very first time, we initiated formal guidance as a company, now that we see that we can predict and be better at telling the market and where we're going and telling the story. And we are forecasting between 87 and 93 million for the third quarter of 2026.
Chris, do the investors accept, understand, and believe the Quake AI story?
I think that's something the market's missing right now. I think that we have to execute as a team, and we have to show that we can take this business and capitalize on the opportunity that we have. We have over 250 megawatts of unmonetized power, 150 megawatts that's in Georgia. That represents a $3 billion annual revenue opportunity for the business. So at this moment, I think the market wants to see some execution, and I think we're starting to show that. We posted a record here in Q2, and we're anticipating on posting a record in Q3.
So that's interesting, right? Not yet monetized from a megawatt perspective. You could even just do it on a per GPU basis. You guys have more than 20,000 NVIDIA GPUs across H100 and H200 generations. What does it take to monetize that capacity, bring it online?
Yeah, so our current estate that's monetized right now, we have about 22,000 GPUs. That's monetizing at about 6 to 7 million per megawatt. And as you've probably seen with a lot of different earnings out there and SpaceX, et cetera, there's a lot of different projections on where that can go for the estates. The 250 megawatts that we do have that's currently unmonetized, If you throw Rubens in there, if you throw Blackwells in there, depending on the customer that we put there and what chipset we put there, that can scale up pretty dramatically from 6 to 7 million per megawatt. You heard Elon talking about 30, he was guessing between 30 to 50 billion per gigawatt. So, the scale can get pretty rapid there. And that is exactly the opportunity we have in front of us. And my team is heads down 100% on monetizing that 250 as fast as possible. It's only been a month and a half. We've got the utilization up on the current estate up to roughly 85%. And now we're heads down on trying to get that 250 monetized, get the right client there, and capitalize on that 3 billion annual revenue opportunity that sits right in front of us.
Again, this was a pivot. So in the quarter gone, the video platform still contributed more than $30 million in revenue. What's the future of that business, right? You see an inflection point where AI is just the vast majority and video goes away, or it's more even set?
I see there's a real opportunity that's coming in the future, and I think it's a little early at this moment, but robotics. I think the next major leg on AI, obviously AI compute, the demand, it's very scarce. The demand is super high. There's very low supply, and that's going to be a very big business going forward for us. But I also think the video side provides a real opportunity when we get into this robotic era of AI. The video data is going to be very compelling in order for training robotics. So we sit in a very interesting place with over 57 million monthly active users on the video platform and a community, a very strong community that can contribute a lot of video data and monetize their video data for that robotic era AI. And I think that creates a moat around Rum Group that the typical neoclouds don't have. We have what the neoclouds have, and that's the power, the land, the GPUs. But we also have something they don't have, and that's the video data.
Rum Group CEO Chris Pavlovski back on the show. Really appreciate your time. Thank you very much. Coming up, leveraged ETFs are growing in popularity, adding even more exposure to mega cap tech and semiconductor names, stocks that have experienced some of the sharpest swings in years. What could that mean for risk across the broader market? It's a really important big take coming up next. By the way, this is what markets look like. A lot of it focused on what's happening with the US and Iran. We see bonds drive higher. Most stocks largely higher. The Nasdaq 100 is flat. Chip stocks outperforming. It's halftime. This is Bloomberg Tech. Welcome back to Bloomberg Tech. One increasingly popular area for investors in the past few years has been leveraged exchange-traded funds. Many of these are tied to AI-related stocks. The dramatic increase in the issuance and trading volume means the risks of these leveraged ETFs are no longer contained by individual investors, but could impact the underlying stocks or even the wider market. Bloomberg's cross-asset reporter Denitsa Tsekova joins us with today's big take, and it is a big take. So many people are reading this morning. Start with the basics. What is the top line that the big take's trying to get across?
We've been talking about the concentration in AI names. So I'm taking you back to 2022. The concentrations of AI exposure was about 26%. Looking at this number this year, we're talking about 58%. At the same time, those ETFs have really increasing AUM and most importantly, in their derivative-based bullish exposure. We're looking at 500 billion of bullish exposure. And as we said, about 60% of this is AI name. Very concentrated. But we're talking a lot about how big they are, but the most important number is how much they're traded. And they're traded a lot. In the last 30 days, they were traded about 70 billion of them. So despite their relatively small part of the ETF universe, they really exert great influence. And that's what we saw in South Korea, obviously SK Hynix and Samsung. We saw really big volatility. And this is one of the few examples where we clearly saw leveraged ETFs at and exacerbate that. Of course, those stocks are not as liquid as the Nvidias and AMD and all those companies that those products are concentrated at. But we saw clearly how big their influence can be in a market like that.
Denitsa, leveraged ETFs, particularly AI-related ones, have been in the news for a lot. But for the section of the Bloomberg Tech audience that just needs the basics, what is a leveraged ETF? How does it work?
So leverage ETFs uses derivative to either increase the exposure of an ETF, so I can have 3 times the leverage of an NVIDIA stock, for example, or it goes the other way. We can have an inverse leverage where the product can go short NVIDIA for 2 or 3 times. Over the past few years, there have been fewer 3x products, so a lot of the products we see are 2 times, but clearly that's a lot of leverage. There were some suggestions about 5 times leverage products that didn't make it in the US, but some of those actually exist in Europe. And what we're seeing in markets like Asia, especially South Korea and Hong Kong, is that those are extremely popular. They're all about really not so liquid products, and retail investors are putting billions. We're talking about the SK Synex products that became the biggest single name leveraged ETF, and it reached 17 billion earlier this year after that regulators reined in, and now it's smaller. But still, we're talking about a lot of leverage in that product.
Bloomberg's Denitsa Tsekova, thank you so much. Go and read the big take. So much traffic on it already today on the Bloomberg terminal and on the website. And, again, this is something that's been in the news cycle a lot of late. Another big story breaking this morning. E-commerce startup Fear used software that allowed it to take credit for sales it didn't drive. And its co-founders, Phoebe Gates and Sophia Kiani, knew about and pushed for those features for more than half a year. That's all according to sources and internal communications. Bloomberg's Olivia Solon joins us with the story. I think, again, start with the basics. How does Fear work?
So Fear sells itself as a sort of digital shopping assistant, and it has an app that kind of recommends products, and then it also has a browser extension which pops up as you're sort of shopping online on retailers' websites and shows you coupon codes for discounts. And if you click on one of those coupon codes or click on a Fear link before buying something, Fear gets a commission for that from retailers.
So our reporting is that Fear's been taking credit for sales that it didn't drive. How?
So as I just said, if you actively click on a link from Fear or you use one of its coupons, Fear deserves to get a commission under the rules set out by its commercial partners. But what we noticed was happening was that Fear was taking credit for sales that it wasn't involved in. There was no human interaction. And it was doing this because of the way that this sort of attribution model works, is that when you click a link, you have to drop a little cookie on the shopper's browser. And that tells the retailer, hey, Fear recommended this shopper to buy this product, and so you should pay them a commission. But what Fear was doing was something called cookie stuffing, which is dropping a cookie at other times, not when anyone was clicking. So it was doing it automatically in the background, using a number of different tools, and including when you were trying to kind of close down Fear's pop-up tool, which, again, you're not supposed to do. You have to be taking an intentional action for it to count, to get a commission.
We're just showing the response from a spokesperson at the company. We're reviewing every transaction we're fully committed to and have already begun issuing transaction reversals to brand partners as a result of many misattribution. The 2 founders, as we said in the intro, are kind of core to this story. What do we need to know about their role?
So we have I've seen internal Slack messages that indicate that they knew about these features and were kind of actively encouraging different ways to drop cookies, even when there was no kind of shopper interaction. We have messages from Phoebe Gates back in December, where she's talking about one of these features that automatically drops a cookie in the background on the mobile browser. And we have messages from Sophia proposing another feature and discussing another way that cookies are dropped automatically without any human interaction.
Bloomberg Tech Editor Olivia Solon, thank you very much indeed. Coming up, drone startup Neros has raised $250 million in a funding round that's tripled its valuation. We're going to talk to Neros CEO Soren Monroe-Anderson and one of its lead investors, Sequoia partner Shaun Maguire. A very big conversation coming up next. This is Bloomberg Tech. Rocket Lab CEO Peter Beck just told Bloomberg the company still intends to launch its Neutron rocket this year as it pushes to take on SpaceX. Shares are lower after Beck appeared to soften the timeline for Neutron's first launch during the company's earnings call. Here's what he said.
Their intention here is to still definitely push hard to go try and get a first flight away this year. But I think the real question that should be asking is what about the 10th flight? Because these programs, obviously first flight is important, but flight number 10 is actually really, really important because that shows that you've got into full sense of scale and cadence and reusability.
Sequoia's made one of its biggest defense bets on drone startup Neros. The company just closed a $250 million round, tripling its valuation to $2.5 billion as it looks to ramp up production of its attack drones. Neros CEO Soren Monroe-Anderson and Sequoia partner Shaun Maguire join us here in San Francisco. I think, they're big numbers. Congratulations on the round.
They're big numbers, but he deserves them.
They're big numbers. People focus on the valuation tripling, right? But I think it's a really interesting idea to be specific about Neros, what you're working on, what the specific technical challenges you're trying to overcome in your lane.
Yeah, well, thank you for having us. For us, this round is really interesting because we are going from being a single product, single capability company with the Archer strike drones into multiple products. So recently we started publicly talking about Bandit, which is the counter UAS interceptor that we are developing. And today we're also announcing Archer AI, which is the first time one of our drones is going to have autonomous capabilities on board. So this is something that we've been really thinking about intentionally as a company. How do we become multi-threaded, multi-product? And we want to have as big of an impact as possible for the warfighter, and the way to do that is delivering more capability.
Away from the specific technology, there's also the ambition to ramp up output, essentially, through the end of the year. I guess that is partly where the capital comes in.
Yeah, and we've been focused on ramping production for a long time. Really, since we started the company, we knew we had to be very forward on production and supply chain. But this year, we've seen a big growth there. So today, we're at about 50,000 drones per year output. And by the end of the year, we'll be at 100,000 drones per year run rate. And we're looking forward. We think that getting the company to 1 million drones per year capacity is extremely important for having a strategic impact for America and our allies. So that's really what we've focused our factory that we moved into a few months ago. We call it Millennium One. We've focused it around this goal of getting to 1 million drones per year vertically integrated.
Shaun, come in here. You led Sequoia's investment into SpaceX, and at that time, the initial investment, but present day as well, right? You would say SpaceX is a company one of one, an asset one of one. In the drone field, there are other proxies you can make your evaluation against. So how did you do that with Neros this time around?
Yeah, look, I think that's a fair question, and a couple of things. One, I think there's a gap right now. There's probably about 5 of these next generation defense tech companies that have actually done useful things in the field. Like it's about 5. It's not
would you
more
say
than that.
Anduril, Shield AI, etc.?
Yeah, I would say like, definitely Anduril. But Neros is one of the companies at the top of the list. Like what they've done is pretty striking. So that's kind of point one. Point two on this question, like SpaceX, when they started with the Falcon 1 initially, that wasn't yet, a just massive leading rocket company. They were just getting started. And then with Falcon 9, it was still not as good as some of the state-of-the-art rockets from the past. But it was really, over the last 5-6 years where just through reusability, through production, through cadence, SpaceX just became, it's 90% roughly of the world's mass to orbit last year. For Neros, the way I think about where these guys are, it reminds me a lot of where the cellular communications industry was in the 90s.
Interesting.
If you think about what is an FPV drone, this may sound crazy, but it's actually it's basically a flying cell phone.
Yes.
So the most important thing is comms, where you don't want, you need very advanced radios that don't get jammed, etc. You need a bunch of sensors, cameras, infrared cameras, other sensing payloads. And you need to be able to do this kind of in a way where you're doubling your performance every year or so to kind of outpace all the defensive capabilities. And so like the actual body of the drones are more or less commodities, like the motors, the carbon fiber chassis, all this. But the payload, you're basically flying an iPhone that is on an exponential race. It's like a Moore's Law development pace. So if you go back to the 90s, there were a lot of companies that were basically buying the same components and making cell phones, but it ended up with Apple as the dominant player, and then Android, as an operating system that went on other hardware. But I think it's going to be the same thing with drones. Like, these guys are building a whole product ecosystem where there's an operating system that lets everything happen seamlessly across drones and to accomplish a mission. And the development is in this it's very similar form factor as a cell phone. It's going to be very hard for people to compete.
Distinction or the core competency is software, what you would say, or?
I would say it's, and I'll let you go in 1 second, it's radios, it's RF. Sensors, it's integration of the electronics in a way that is scalable and reliable and is on an exponential trajectory, the same way making a cell phone is, plus the operating system to integrate with their other products, plus being able to manufacture insane numbers of units with a very reliable supply chain.
That's key.
Yeah, I think Shaun hit the nail on the head. And historically, we've been more hardware focused than software focused. What we really wanted to solve off the bat was the manufacturing of these drones without a Chinese supply chain. When we started the company 3 years ago, there was no way you could go and buy an FPV drone that did not use Chinese components, Chinese chips. And so that was really our core focus over the last 3 years, was building up this ecosystem of radios, flight computers, all these other things that are critical going inside of the drone, and being able to actually manufacture them at scale. Now that we've established a strong baseline there, we are pushing more on the software aspect with the autonomous capability that we're adding, as well as using that same component ecosystem from Archer into Bandit, our new platform. So we really think there's this flywheel where you build up this amazing base of components and it allows you to go build other types of platforms very quickly.
You said it yourself. 3 years ago, you founded this company. To date, you have what you describe as major contracts with the Army, Marine Corps, contracts with every component of SOCOM, and other allied countries. Give us the backstory of how you were able to do that in that period of time.
Yeah, we've had to move really fast. We saw 3 years ago, our primary focus when we started was just in Ukraine, working alongside the Ukrainians, building a better drone for them. And at that point, the Pentagon did not really care about what we were doing.
From a procurement perspective,
they didn't really think that small drones had a massive impact for the U.S. warfighter. We had this bet that they would be and that the Pentagon would realize that. And I think we've had a really interesting front row seat to watching that realization happen over the last 18 months and being well positioned to start delivering on real contracts as America has said, hey, we actually need drones. We need drone dominance. And so that has been, because we focus very heavily on building a useful product in Ukraine off the bat and then scaling the production, I think we've shown that we are really one of the only drone companies in America that can scale very quickly and actually deliver when these big contracts are coming down the pipe.
Soren's too humble. Can I just add?
Please, jump in.
So Soren is a young man. Many people don't know this, but there's professional drone racing leagues. There's 2 of them. He was the world champion in one of them and professional in the other. So starting as a young kid, he was just obsessed with drones.
That's the technology story, your background story.
And then kind of when the war in Ukraine started, he's very patriotic for the West in general, like for America, for Ukraine, for the entire West. And as a young guy, very early 20s, maybe even 19 at the time, basically flew to Ukraine and just started trying to help the Ukrainians, learn how to fly drones and push the limits of their technologies. That led to, really getting the company going. And he's just been delivering everything he said he's going to do, he's done. And so it's just led to a big gap between Neros and most of the other competitors.
Shaun, can I ask you a slightly more difficult question about the future? Because, you don't have a crystal ball. But this is about reindustrialization for that specific vertical, the national interest of this country or the West. Those contracts we've discussed are with the public sector, essentially. So how do you model for that TAM in the future? You are an investor, first and foremost. How do you have a sense of how real and big the opportunity is?
Good question. So I think about it in 2 ways. Way number one is I've been very lucky to see SpaceX up close and then follow Tesla. And by seeing how SpaceX operates, which to me is the most vertically integrated company in the world, and I feel pretty confident in that statement, my vision is that there should be 10 companies like SpaceX in America, and that is how we reindustrialize. And what that means is that you start by selling one thing where you buy a lot of your components from other people, and you over time vertically integrate your supply chain more and more and more. And then once you have this vertically integrated supply chain, I mean, like SpaceX is now the biggest. They make PCBs. They're the number one producer of PCBs in North America for Starlink user terminals. That's trained a lot of other people in how to make PCBs that we had lost the skill in the West.
That's a supply chain ripple effect.
Yeah, it's a whole supply chain ripple effect. And so the people that learn how to, make steel alloys, et cetera, like they go and kind of do other things. And so SpaceX has done it in space, Tesla's doing it in automotive. I think if we had 10 companies that became national champions in some vertical, roughly 10, it almost doesn't even matter what they are, that will fully reindustrialize America. And so I think Neros, by being at the beginning of this exponential trend of drones and warfare, they're just getting pulled along and they're able to compete even with China. And granted, China's vastly far ahead right now in drones, but they're close enough that they can actually compete. And my forecast is 10 years from now, people are going to be shocked by how vertically integrated this company is.
So that also raises questions of economics, right? You talked about establishing the supply chain. You've raised a pretty sizable round. Is it just purely dependent on scale in order that you give the value proposition to your customers, the different arms of the defense apparatus of this nation? Or is it still a technology advantage that you think will win out in the end?
I think it has to be a good combination of both. We've seen that today we can deliver a drone that is highly capable, that when our drone was certified for usage by the Department of War, it was about an order of magnitude cheaper than anything else. So we've already been able to massively reduce the cost of using small drones for the Department of War. We see that over time, what scale is really going to get us and what investment into the space is going to get us is actually closing the gap on some of these critical technologies. So Shaun mentioned radios as an example. This is one of the areas where Chinese drones are incredibly good. They iterate radios extremely quickly, and DJI, which is the world leader in drones, has built custom silicon around their radio stack, and they have by far the most performant radio stack in the world. And so we think that the investment that is going into the defense space, and really what Neros wants to do, is take that volume and take that capital and put it towards these foundational technologies that will allow us to actually close or even get ahead of where China is at today in consumer drones.
We just have 2 minutes left in the show, which is unfortunate, but I want to get to the backstory of Bandit, the new interceptor drone. This was catalyzed by a specific event of the war in Iran. Could you just pick it up, both of you, and why you moved so quick?
Yeah, I mean, we had been watching the development of interceptor drones in Ukraine for the last year and a half, and it's something that we knew was going to be on our roadmap, but we've tried to be very focused as a company because we do not want to get distracted and build too many things at once in lower quality. And so we really had to pick the right point to go and build Bandit, our interceptor. But when events started happening in the Middle East, we saw that American assets were getting targeted by Iranian drones, and we just did not have a reasonable defense
this
to that.
Is interceptor. It literally intercepts
other drones. So
yes.
we goes after Shahed style drones and takes them out of the sky. And this is the most economical way to defend against these types of drones. And so when we saw U.S. service members' lives in danger in the Middle East because of those threats, we knew we needed to act quickly.
Shaun, your 60-second assessment of how they moved quickly, their execution on that.
I think this is something that a lot of software investors get wrong about hardware companies. For software companies, when you have one successful product, it doesn't give you much of an advantage for building a new product. In hardware, when you have one successful product, the probability of having another successful product is very, very high. So you get to reuse a lot of the same components. You get to, you already have the supply chain. You already have the electrical engineers, etc. And so these interceptor drones, there's actually probably 80% or so overlap in the actual componentry and know-how. And so it's just, I think this will be the second, but not the last product these guys make.
Again, it's a big but early round. I'm sure you'll have be back on the program in future raises. I appreciate you both taking the time. Soren Monroe-Anderson, Neros CEO, and Shaun Maguire, partner at Sequoia. Thank you very much. Some other news headlines in Talking Tech. First up, the White House has rolled back a TikTok ban on government devices. A memo from yesterday states that TikTok is no longer a, quote, covered application for the purposes of the No TikTok on Government Devices Act, effectively allowing the app back onto federal devices. Plus, Anthropic and Riot Platforms joined forces on a $9.1 billion deal that would have the Bitcoin mining company supplying 191 megawatts of capacity to Anthropic over 20 years, all according to sources. The move underscores Anthropic's efforts to gather enough computing power to meet its customers' demand, and OpenAI is said to be buying back $7 billion worth of shares ahead of a potential IPO, according to sources. The ChatGPT maker is said to be buying back shares from current and former employees instead of tapping external investors for that tender offer. We're still tracking more earnings. Yes, it continues. After the bell, CoreWeave, again, a story about moving quickly to get compute capacity online. The stock's treading water, up 0.8% before the print. Largely speaking, it's events in the Middle East that are driving public equity right now. Like, there's a big movement in bonds that might be going on here. There's the kind of feel good around a day two story on Nvidia's $500 billion deal with Wall Street to collateralize compute. The Nasdaq 100 is flat. The SOX is higher, 0.9%. And again, Intel, $20 billion share offering. It had marketed $15 billion. We're reporting that there was $100 billion of demand. That is all playing into what's happening on your screen right now. My goodness, what a fast start to the week. It is only Tuesday, so much across public and private markets. That does it for this edition of Bloomberg Tech. Please recap on the podcast. You know where to find it on the Bloomberg terminal, as well as online on Apple, Spotify, and on iHeart. From San Francisco, this is Bloomberg Tech.